day friends, this is Kaira Ahuja and welcome back to the Fund Managers View Show at Emkay Investment Managers. Today we have with us Mr. Manish Sonthalia, CIO at EIML. Welcome Manish sir to the show. How are you doing today?
All good, thanks. How are you?
Very well sir. So after this downward spiral in the markets, where do you see this heading to?
Yeah, so January and February have been nasty months for the markets as a whole. It has unnerved a lot of people, particularly the newer investors who have come into the market. But I would believe that we are just in a healthy correction, so to speak. I really don't see that India markets are going to crash significantly from these levels. So I have been maintaining that 26,000 was an excess based on Indian fundamentals. 22,000 we have broadly priced in our fundamentals, and any levels below 22,000 is a great buy zone. And so we have seen those 22,000 exactly on the Nifty or thereabouts, 22,050. And I am of the belief that we should be buying the markets. It is now a case of buying the dips. The extraneous factors which were against Indian markets, which was the appreciation of the US dollar and somewhat of a very stable the oil prices, they are now correcting on the downside, and both of which are basically helpful for India. So US dollar, actually dollar index correcting is good for the Indian rupee, and the oil prices correcting is good for Indian balance of payment. So from that point of view, given the fact that even the public issues or the IPOs have now almost come down to a trickle, and even the private equity exits, etc., which were a major problem in the Indian markets as far as the fund outflows are concerned, they have now gone very slow. And so these are helpful for the markets from a technical point of view. So my take is broadly we are somewhere closer to the bottom, and these are great levels to buy. Somebody who was buying the dips at 26,000, it's a great time to buy the dips now.
Perfect. Tariff wars raging on one side, FTAs on the other. Do you think India will be able to walk on the right rope?
So this is now the raging issue globally ever since the regime change in the US. Every country is feeling the heat, and even India is no exception. And partly the reasons for the recent bout of correction in Indian markets was the rhetoric around the reciprocal tariffs. So I think India's surplus with the United States is closer to around $40–45 billion, and we have a massive trade deficit with China. So we have to balance both of them if we have to keep both our trading partners happy. So I think the solution to this is basically finding free trade agreements with the United States so that at concessional rates of duty, you can have both an import and export from the United States coming into India and going out of India. And on the other hand, with our Chinese counterparts, we need to have joint ventures so that we can allow the Chinese to have some equity stake in the companies in India, so that we manufacture in India. And from here we actually supply it to the United States, because the major bone of contention is between the US and China. They don't want to import massively from China in a quest for de-risking the supply chain. And herein I think JVs with Chinese companies will come in quite handy. So I think this too shall pass, and I don't think that it's an unsurmountable sort of a situation, and we are much better off than many other countries where tariffs have been put, the likes of European Union or China or Mexico or Canada, and our surplus with US is not that great. And ever since Modi ji has actually visited the US, there is also some talk about increasing procurement of arms so as to balance the trade surplus that we have with the US. I think our Commerce Minister is right now in the US trying to form a bilateral trade deal which is going to be beneficial for both the countries. So we shall keep our fingers crossed and hope that things work out best in our favor. So it's a wait and watch. It's a story which is still evolving. The last is yet to come. Last bet on this topic is yet to be announced. So wait and watch mode is where I would put this entire episode. But yes, it's a burning issue at the moment.
Right. In your recent interviews with ET, Money Control and CNBC, you mentioned the India-US tariff differential is at around 5%. Do you think this will be enough for us to wade through the tariff wars?
Yeah, so let's put the things in context. Differential duty between basket-weighted Indian exports and Indian imports is around 4.9%. So I have rounded it off to 5%. That is the differential duty. If you look at the explicit numbers, it is closer to 3%. Of the 3% duty is what United States charges us on the goods that we export out of India, and Indian government charges US goods at the rate of closer to around 7.7 to 7.8%. That is how this 4.9% comes to. Let's say the 5% duty. This is on a basket weighted basis, everything put together. But there are certain items where we charge US goods quite a bit. And some of these are basically agricultural products, where India charges close to 30% duty. Whatever is imported into the country from US, the likes of almonds and walnuts and all these things, we charge them 30%. Why? Because we have to protect our farmers. Farmers are a poor community in this country, so we need to take care of the interest. We can't be basically allowing this import free or a very low rate of duty. These guys will get shortchanged. Another major item of import where we charge excessively somewhat is basically your automobiles, where we charge them something like 30 to 40%. Now, there has been talk that India charges 100% tariff on automobiles. I don't think that is correct. If we have reduced, there's always been a reference to Harley Davidson, where India charges 150% or 100%. No, we have reduced the duties to 30%, but still the 30% is there. Now, mind you, this is on automobiles, that is passenger vehicles or two-wheelers, that the rate of duty is 30-40%. But if you take into account the auto components, we don't have excessive duties. So if you take automobiles and auto components, they would be broadly, a decent rate of duty, not very excessive duty. United States always talks about very excessive duty on American liquor, which is imported into the country, the American bourbon whiskey, where they say that we charge something like 150%. Now, government of India has already reduced the duty from 150% to anywhere between 50 and 100%. So then you would have apparel, where we would be charging somewhat more. We would have footwear, where we would be charging somewhat more. But by and large, there will be certain minerals that we would be charging somewhat more at around 25%. But otherwise, we don't charge excessively. As far as the gems and jewellery space is concerned, the diamonds that go into the US comes back into the country because it goes through zero duty and then comes back. So I really don't think that this 5% differential duty is going to make hell of a lot of difference. Total trade number with the US on an annualized basis is $150 billion, and if you have a 5% additional duty, the total impact is going to be $7.5 billion. Now, it is not very clear whether the US president talks about just the differential duty, or they would also include a cascading impact of local taxes. That is to say, 5% plus GST will also be taken as a differential duty component, or just the headline differential duty component, that 5% which is going to be the addressable issue. So if the GST components and local taxes are also added to the differential rate of duty, then the impact would be big. But otherwise, that 5% does not seem like a earth-shattering thing as far as the Indian economy is concerned. And mind you, if we were to enter into a free trade agreement, that is to say that a reduced rate of duty imports and a reduced rate of duty exports, again it's a work in progress, but given the cost structures which are there in the United States, very few items manufactured in the US can find a very big market out in India at the price at which they would be profitable. Because the cost structure is very high, they won't be able to compete with the cost structures because we have a very benign labor cost. There the labor cost is very high, the power costs, these are two major costs which are very high out there and which are very decently priced out here, and that brings the differential cost structure in most of the manufactured items out there. So again, we need to wait and watch whether the free trade agreement with zero duty or reduced rate of duties will come into action or force. It's a work in progress, but on a headline basis, this 5% differential duty does not seem to be an earth-shattering event as far as India's reciprocal tariffs announcements to be effective from 2nd of April would imply.
Right. I think that does put a lot of things in perspective in terms of tariff. But moving on to our fund, the India's golden decade of growth has been this ambitious strategy, that has looked at 5 themes or 5 trends. How do you see these themes playing in the current dynamics of the market?
So yeah, the 5 themes are basically your consumption, manufacturing, financialization, digitization, AI, and your green energy.
Right.
I think consumption comes back in India's focus in a very big way post the budget. And I think the driving force of the next up move in the markets, whenever that happens, in the next 1 quarter, 2 quarter, is going to be consumption. The recovery in the markets is also going to be led by consumption and financials. And, the shift away from renewables is somewhat because of a regime change in the US, where there is more preference for fossil fuels, because of problems of evacuation of generation capacity. We are not yet fully there. So signing of PPAs, etc. are still an issue. So yes, the theme is still valid till 2030. We'll take a somewhat backseat. You would have noticed we have booked some of the profits in our renewable energy stocks that we had, and really focusing hugely on consumption, which will be a major overweight stance. So anything to do with hotels or fast fashion or two-wheelers or airlines or mediclaim or I wouldn't include jewellery, by the way, in this space, is because of the fact that the gold prices are very high and it's going beyond the reach of affordability of a lot of Indians. That is one. And gold metal loans today have gone up in value significantly. So one of the stocks where we did very well till far, we would not look to buy into jewellery stocks just now, but diversifying away from jewellery, more into QSRs and restaurants and automobiles and fast fashion and travel and your mediclaim, health insurance, all these spaces would be much more conducive. Financialization, I think it is a very strong buy on dips. India's story is not lost, and this theme is going to be relevant. Only thing is that today you're getting stocks in this theme 25-30% cheaper. It makes much more sense to buy them. And digitization is the new revolution. AI is being talked about everywhere, and India will have its place. I am quite upbeat on even the technology space. Within the manufacturing space, pharma appears to be a very big bright spot for India as far as our generic exports to the United States or even our own domestic consumption is concerned. So except for, let's say, the renewables, all the 4 themes are alive and kicking and would likely do quite well in the next 1 year or so.
Right. Since you mentioned about digitization and AI being an integral part of the strategy, how do you see the structural shifts, now that this DeepSeek reveal has come?
So, big announcement by Chinese tech company DeepSeek is the new competition to ChatGPT. Okay, and by the way, India is also working on its own large language model (LLM), and it's going to be ready in the next 8 to 12 months. This is an announcement made by our telecommunications and IT minister, Mr. Ashwini Vaishnaw. So from that point of view, India will also have its own DeepSeek in some time. So it's not going to be an earth-shattering diversification away of our capabilities in the technology space when we compare ourselves with, let's say, the Chinese counterparts or even the ChatGPT. The only thing in AI is what we are seeing is the bright spot is that more AI related deals are coming to third party IT vendors. So even the GCCs, which is Global Capability Centers. So we need just one killer application using AI, and India will make itself relevant in order to provide services surrounding that application. So again, the story remains very intact, given that the IT space is coming off a very low base. There is hiring that is starting to pick up. The new government in the US talks about giving tax breaks and spending more on technology. A crypto reserve is being talked about. Again, these are very strong points for the technology space as a whole. You have 5G and 6G spends now on the up move. You have large order book positions on Indian IT companies, which will get translated into your revenues. You have the rupee depreciation, which is going to help the cause of boosting your revenue growth as well as margins, because a large portion of the revenues will get offshored into India. So remain quite positive on Indian IT. I don't think DeepSeek is going to change a lot of things. Maybe one more area, this was monopoly of ChatGPT. Now is going to be now between DeepSeek, and we'll have many more competitive applications. India might also have its own large language model soon. So that doesn't really bother me that much.
Okay. So Manish, I always pick your brains on sectors, and we always do this quick rapid fire. But your quick views on these sectors in manufacturing, auto.
Auto is somewhat on a soft lane as of now as far as the domestic demand is concerned, but I think give it a 2 or 3 more quarters, given the boost on income tax savings that's going to come, and the leg up that's likely to be seen from the 8th pay commission going into the next year, where a fitment factor of around 2.5 to 2.8 is being talked about, which essentially means that there is going to be an increase of 20 to 30% salary for government employees going into the future. So all these things bode well for consumption, and obviously automobiles will be a very strong part of it. And it's at the moment soft, but I'm not negative on autos per se if you were to take a 1 year view. What was the second sector?
Pharma.
Pharma is quite strong, and I think this whole narrative around tariffs being imposed on generics, again I come back to the same point. The cost structure for US is so high. Even if manufacturing was to go back to the US, the cost of manufacturing these generic medicines will be so high, it's going to only raise the prices for American consumers. So in a way, China's pain is India's gain as far as the pharma space is concerned. And we are experts in manufacturing formulations, which is small batches. So from that point of view, I am absolutely gung-ho on the pharma sector, not only from the generic exports point of view, but also the CDMO point of view. Because again, out here, China's pain is going to be India's gain. So, and domestically, we are clocking quite well. And I think over a period of time, given that good manufacturing practices would also be implemented for domestic pharmaceutical companies, you'll have a lot of people who's going to go out of competition because of not being able to comply with the most stringent norms of running their plants. So from that point of view, I think all the engines for the pharma sector as far as India is concerned is doing well.
Let's move to BFSI. Within that, banking.
Banking is very positive. Anything to do with the lending and borrowing business, whether it be banks, whether it be NBFCs, these two spaces, it's quite positive, I would believe, because India is now embarked on a journey of cutting down rates. And over the period of next 1 year, we are basically going to bring down the cost of capital for borrowing. And that should hopefully give a boost to the volume of lending or volume of borrowing by individuals. Secondly, we were running a very tight liquidity situation. Today, liquidity is easy. The central bank RBI is taking a host of measures to tide over the liquidity deficit we had in the recent past, and that again bodes well for the Indian financial system as a whole. Both the banks and the NBFCs are likely to be doing much better. I think in this space, the larger entities, both in the banks and NBFC space, would be much more better placed than the tier 2 banks. That's what my take is.
Financial services?
Absolutely, Gango. I think within that, insurance as a space is available at very cheap valuations, both the life insurance as well as the health insurance space. And I have been a strong votary for the capital market related themes, whether it's being exchanges or repositories. Only thing that you have to keep in mind is the valuation. Financial services as a theme is very good, but some of these names are trading at 5 PEG, 3 PEG, 4 PEG. These won't hold. You have to take a tab on the growth and then the price that you want to pay for that growth. Within that space, even financial services is very good. And I think very recently we have turned very bullish on insurance as a space, and within that, you in the golden decade PMS, and we have even bought into a few of the health insurance. There we find the valuation very, very appealing.
Moving to energy. Oil and gas?
Yeah, so again, oil prices are on the down, and that's going to help Indian refiners quite a bit. And so this is in, the energy basket as a whole is in a sweet spot. As far as the power side of things are concerned, we have a surplus on the day power side currently. Evacuation is an issue. PPAs need to be signed. These are some of the worrisome points. But otherwise, on an overall basis, energy, both on the crude oil side as well as on the refining side and marketing side of fossil fuels, they seem to be doing quite well. They should be broadly outperforming the rest of the bank. We just need to keep in mind that rupee doesn't depreciate significantly, and mind you, very recently we have seen that rupee is now appreciating as opposed to depreciating, given that dollar index is on the fall.
Quick views on solar and wind within energy?
Not so gung-ho about these two spaces as of now. Not that 2030 targets are not looking very appealing, but the fact is today there is a sea change in the perspectives of the entire renewable space. On the one hand, on the solar side, we have a huge arbitrage between the cost structure, what Chinese are offering and what we are offering. So, and then we have very high valuations. Then there is a problem of evacuation, PPAs. I think these are somewhat headwinds within an overall very strong tailwind for the space till 2030. Again, out here, I think it will be about valuations per se, and valuations, though have corrected in the very recent past, is still not in the buy zone. So I'm not so very strongly positive on wind and solar at this given point in time.
Okay. Moving to tech, you already spoke about IT and AI. What about fintechs?
Financial fintechs, again, valuation issues, nothing changes at the margin as far as the fundamentals are concerned. But again, what is the valuation that you want to pay? Mind you, 2026 is all going to be about very carefully trading on valuations. Markets have given up a lot of gains just because of the simple reason that Indian markets were trading expensive. So to be mindful on valuations, fintech is one space. Again, this space looks somewhat exorbitant in terms of valuation. So fundamentals are good, but valuations are a headwind, I would put it that way.
Perfect. That was a lot of insights on a lot of sectors. But of course, financial year 25 almost drawing to a close. What will be your core investing mantra for financial year 26?
So I think it's basically I would be buying the dips here on. I think we have broadly seen the worst. The narrative around tariffs and differential tariffs and reciprocal tariffs somewhat is overblown according to me. We are a domestic centric economy. By and large, we produce and consume ourselves, and India's share in the overall global trade is hardly 2-3%. That's not much. Secondly, the major headwinds as far as the FII flows were concerned was mitigated and is being mitigated through domestic inflows on mutual funds. The big leakage in calendar year 24 was on account of the plethora of IPOs and private equity exits and promoter selling. These have abated massively. That is not to say they're not going to come back again, but it's a cycle. We go through a top and then we come to a bottom, and again when the markets go up, you'll have a lot of IPOs again coming through. But right now, if the markets were to fall below these levels, you could broadly see a lot many more buybacks come into play. Not IPOs, but buybacks. So here we are. On a delta basis, FY26 will be better than FY25. So FY25 Nifty 50 EPS growth is going to be 5%, coming down from 25% in 2024 fiscal, and in 26. I am broadly penciling in around 10 to 12%. So from a 5% to 10 to 12% is an augmentation of doubling of income or corporate EPS growth. We have broadly priced in most of the negatives as far as macros are concerned. One should be mindful of valuation immensely, not to be complacent about at all. And I've always maintained that 3 PEG and beyond, India's any sector, any market, any company wouldn't broadly sustain. Indian markets today are trading at 20 times P multiples, and for a 10% growth, we are broadly at 2 PEG. Within any market cap, large cap, mid cap, small cap, micro cap, if you were to buy anything within that price band of 2 PEG, and you are correct in your growth estimates, I don't think capitalization is going to be a worrisome factor. I'm not in the camp who believes that you should not be touching mid caps and small caps. You should only be buying large caps. I have echoed my opinion on the same. If you were to exclude certain companies within the mid cap space, if you were to exclude certain companies within the large cap space, the public sector units, if you were to exclude some of the heavy allocations of a few names in the mid and small cap, they all don't look very either cheap as far as the large cap space is concerned, or the very expensive as far as the mid and small cap. So I am market agnostic at this point in time, and I would believe that because of the heavy correction that you have seen in the mid and small cap space, if there is a revival that will come, the pullback is going to be much sharper in the mid and small cap space as opposed to the large cap space. And so broadly this would be my mantra. Consumption is going to lead from the front. Give it 2 or 3 more quarters and you will see the thematic absolutely change away from investments to consumption. It generally takes 2 or 3 more quarters, 2 or 3 quarters to play out these changing dynamics. And one should be mindful only of valuations. And I think now India remains a buy on dips. I'm not very bearish on India. Our markets from around 22,000 levels on Nifty.
All right. Thank you, Manish. Great insights as always. Thank you for being on the show. Key takeaway from here is buying on dips. Thank you everyone for watching and stay tuned for our next episode. Until then, happy investing.